The average American retires with around $250,000. That's after 30 or 40 years of working. Now, what if I told you there's a way to turn a single $50,000 investment into over $4 million? And the math isn't complicated, the funds aren't secret, and you don't need to earn $200K a year to do it. Would you want to know how? Because here's what drives me crazy. Every single week, I talk to people who have $50,000, $60,000, even $100,000 sitting in a savings account earning 3 or 4%. And they have no idea that the same money in the right funds could be growing at 14, 16, even 18% a year. That gap between 4% and 14% is literally the difference between retiring with $400,000 and retiring with $4 million. Same starting amount, same person, same job. Just a different decision about where the money sits. That's what today's video is about. I'm breaking down 5 specific Fidelity funds, and I chose Fidelity for a reason that's going to surprise a lot of you, especially if you're sitting on Vanguard or Schwab accounts right now. I'm going to show you the exact compound growth math with a calculator, not projections, not guesses, actual historical numbers. And later, I'm going to walk you through one calculation that honestly changed the way I think about retirement. It involves $500 a month, and the result is a number I had to check 3 times because I thought I did the math wrong. But first, let's talk about why Fidelity. Why Fidelity? Before the funds, let me answer the question I know some of you are already asking. Why Fidelity? Because when I sat down and compared Fidelity against Vanguard and Schwab side by side, Fidelity won in almost every category that matters. Here's the one that still blows my mind. Fidelity offers a fund that charges 0.00% in fees. Not low fees, not competitive fees, zero. Literally nothing. Schwab's cheapest total market fund still charges something. Vanguard's VTI, 0.03%. Sounds tiny, but over 30 years on a large balance, that adds up to tens of thousands of dollars out of your pocket. And beyond fees, Fidelity offers actively managed ETFs, where real portfolio managers are picking stocks and charging you ETF-level prices to do it. One of their funds has been averaging over 18% a year. Try getting that from a passive index. $7.1 trillion in assets under management, $37.7 billion in revenue, 79+ ETFs. This is a machine built for investors who are serious about growing wealth. Okay, let's talk about the 5 funds. Fund number 1, FDDV, the Paycheck Fund. This one is for everyone who thinks dividend funds are boring. You are about to change your mind. FDDV, the Fidelity High Dividend ETF, doesn't just hold grandpa stocks. Pop it open and you see Nvidia, Microsoft, Apple, and JP Morgan, Procter & Gamble, Coca-Cola. Growth and income in one fund. The numbers: 2.743% dividend yield, 0.15% expense ratio, about 112 high-quality holdings. Average annual return since inception? Roughly 13%. But here's the stat that stopped me cold. Its dividend growth rate last year was 22%. That means your paycheck from this fund didn't just show up. It got bigger, a 22% raise. From a fund? When was the last time your boss did that? Beta of just 0.82, meaning it's smoother and less volatile than the S&P 500. The Motley Fool named it a top Fidelity ETF pick for 2026. This is your anchor, your income engine, your portfolio's foundation. Fund number 2, FTEC, the growth engine. If FDDV is the paycheck, FTEC is the rocket fuel. The Fidelity MSCI Information Technology ETF has delivered an average annual return of 16.82% since inception. Its 10-year annualized return, 21.1%. Its 3-year, 27.2%. Those are not projections. That's what the fund actually returned. Morningstar, the gold standard of fund ratings, gives FTEC a 5-star rating and a gold medalist designation, their highest possible recommendation. Inside, 290 tech stocks: Nvidia, Microsoft, Apple, Broadcom, Palantir, AMD, Oracle. The companies building artificial intelligence, cloud computing, the entire digital future. Fee: 0.08%. That's $8 per year on every $10,000 invested. You spend more on coffee. Yes, it's down about 3% year to date in early 2026 because of the February tech pullback.
But here's how smart investors think about that. A fund with a 16% historical average just went on sale. That's not a warning sign. That is a buying opportunity. FTEC is the engine that makes the big numbers possible. Remember that when we get to the math. Fund number 3, FZROX, the Free Foundation. This one is the mic drop of the entire video. FZROX, the Fidelity Zero Total Market Index Fund, charges 0.00% in fees. Not 0.03, not 0.01, 0. Fidelity built their own proprietary index, cut out the middleman, and handed the savings directly to you. 2,534 stocks, the entire U.S. market. Large cap, mid cap, small cap, all of it. $33.5 billion in assets.
Returns? 23.94% in 2024, 26.21% in 2023. 5-year annualized return around 13.75%. Now here's the number I want you to screenshot. If you invest $50,000 and it compounds at 12% for 30 years in a fund charging just 0.2% in fees, you lose roughly $78,000 to those fees. $78,000, more than your entire original investment. Gone to fees you barely noticed. In FCROX, you lose 0. Every single dollar stays in your account, compounding year after year after year. The free fund isn't just a nice perk, it's a wealth-building superpower. One important note, FCROX is technically a mutual fund, not an ETF, and it's only available through a Fidelity brokerage account. No minimum required, but you can only buy it at Fidelity. Fund number 4, FENY, the 2026 wildcard. Okay, this one is on fire right now, and I need you to pay attention. FENY, the Fidelity MSCI Energy Index ETF, is up 26.65% year-to-date as of early March 2026. In February alone, 9.6% in a single month. Energy is the #1 performing sector in the entire market right now. Not tech, not AI, energy. The sector everyone forgot about is absolutely crushing it. FENY holds the biggest energy names in America, Exxon, Chevron making up 38% of the portfolio, plus Williams Companies, ConocoPhillips, EOG Resources. Fee is just 0.08%, dividend yield around 2.5%. And here's the stat I genuinely did not expect. FENY's beta is 0.52. It moves less than half as much as the S&P 500 on any given day. One of the hottest performers in the market and one of the least volatile holdings in this entire lineup. Pro-energy policy environment, global demand, supply constraints. Analysts calling for a continued energy bull run through 2026 and beyond. This is your inflation hedge, your commodity play, and your contrarian bet, all in one low-cost fund. Fund number 5, FBCG, the active weapon. All right, this last one is going to surprise you because I'm usually the guy telling you to avoid high fees at all costs. FBCG, the Fidelity Blue Chip Growth ETF, charges 0.57%. That's the highest fee on this list by far. So why is it here?
Because since inception in June 2020, it has averaged 18.39% annually. Its 3-year annualized return is 30.8%. Those aren't good numbers. Those are elite numbers. 2 of Fidelity's top portfolio managers, Sonu Kalra and Michael Kim, are making daily decisions across 185 stocks: NVIDIA, Microsoft, Netflix, Meta, Apple, Alphabet, Amazon. A concentrated, actively managed bet on the AI revolution. VettaFi named it ETF of the Week heading into 2026. TipRanks analysts call it undervalued. Morningstar said in February 2026 that it stands tall on bold bets. Here's how I think about the fee. If the fund returns 18% and charges 0.57%, I'm netting over 17%. I will pay 57 cents to make $17 every single time. The question is never whether you pay fees. The question is whether those fees are worth the performance, and FBCG's managers have more than earned their cut. Okay, this is the moment I told you about at the beginning. Grab a pen, screenshot this, because these numbers are going to hit you hard. $50,000, one-time investment, nothing added, just compound interest doing what compound interest does. At 10%, the long-term market average, your $50K grows to $872,000 in 30 years. Solid, but not $4 million. At 12%, $1.5 million in 30 years. At 14%, a conservative blended estimate for this 5-fund portfolio, your $50,000 becomes $2.55 million in 30 years and crosses $4 million around year 34. From $50,000, zero extra contributions, just time and the right funds. But here's where it gets insane. This is the calculation I checked 3 times. What if you add just $500 a month on top of that $50,000? That's a car payment. That's dinner out a few times a week. Money most people are already spending on things they can't even remember. At 14%, with $500 a month, your portfolio hits $6 million in 30 years. $6 million! $50K upfront, $500 a month, 14% average return, 30 years. $6 million. The difference between no monthly contributions and $500 a month at that return rate is $3.5 million. That's the price of a monthly car payment in reverse. And for anyone watching who's thinking, I'm 52, I don't have 30 years, the math still works. $50K at 14% over just 15 years is $379,000. Add $500 a month and you're well past $500,000. On a 20-year timeline at 12% with monthly contributions, you clear $1 million. You are not too late. The math still works. It just works even better the sooner you start. Here's what I want you to do right now. Step 1. Look at these 5 funds. Pick 2 or 3 that match where you are in life. You don't have to start with all 5. You just have to start. Step 2. Open a Fidelity account tonight. It takes 10 minutes, and set up an automatic monthly transfer, even $200, even $300. Just automate it and let compounding do the rest. Step 3, drop a comment below. If you could only pick one of these 5 funds, which one are you going with and why? I read every single comment, and I'm pinning one at the top to kick off the conversation. Step 4, share this video with one person who has money sitting in a savings account doing nothing. Your friend, your sibling, your coworker. One video can change someone's financial trajectory. Be the person who sends it. And if you're not subscribed, what are you waiting for? Every week, I'm breaking down ETFs, dividend strategies, compound growth math, real data, no fluff, no hype. Hit subscribe, hit the bell, and I'll see you in the next one. Your future self, it's already thanking you. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Past performance does not guarantee future results. Please consult a licensed financial advisor before making investment decisions.